Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Kratos Defense and Security Solutions.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we get into the heavy analysis today, we really need to talk about the absolute whiplash that investors are experiencing in the defense sector right now.
Yeah, whiplash is definitely the right word for it.
I mean, if you are holding Kratos right now, you have been on a historic ride. If we just zoom out and look at a 3-year window, this stock surged over 7 times in value.
Right.
And looking at just the past year alone, it was up, what, over 260%?
Yeah.
It pushed right past that $92 mark.
Exactly. It hit $92.14.
But then, and this is why we're talking about it today, we saw this sudden and just violent 22% monthly plunge.
A massive pullback.
Yeah, a pullback of that magnitude immediately forces a critical question for your portfolio. If you're holding this, you have to ask yourself, is this a structural breakdown signaling that you need to exit right now? Or is it just a purely mechanical sell-off, creating a really rare entry point?
And that is the central mystery we need to resolve today. To really determine whether that double-digit drop is a glaring red flag or a golden opportunity, we have to isolate what Kratos is actually doing differently than the rest of the defense sector.
Because they are operating very differently.
Completely differently. The legacy defense primes, your massive conglomerates like Lockheed Martin, they operate on a very specific traditional model.
Right, the multi-billion-dollar platform.
Exactly. Aircraft carriers, next-generation stealth fighters. These are programs that take decades to design, test, and finally field. Kratos has built its entire foundation on an opposing philosophy.
They're going for an agile, low-cost framework. And if you look at their core business, they are heavily concentrated in unmanned aerial systems and hypersonic testing. It seems like they're aggressively targeting the exact shift in procurement doctrine that the Pentagon is undergoing right now.
They are. The focus is specifically on what the military calls attritable systems.
Let's unpack that word for a second, attritable.
Sure. In modern warfare scenarios, deploying a $100 million manned aircraft into heavily contested airspace, it carries an unacceptable risk, both in terms of human life, obviously, but also financial capital.
Right, you lose one plane, and that's a massive strategic and financial blow.
Exactly. So Kratos is manufacturing high-performance, autonomous drones that are sophisticated enough to perform these complex mission profiles, but they're cost-effective enough that losing them in combat is an acceptable strategic trade-off. That's what attritable means. They're essentially consumable assets.
And a major piece of that revenue pipeline comes from their position as the primary provider of target drones for the U.S. Air Force, the Navy, and the Army.
Which is a brilliant niche to dominate.
It really is. Because we aren't talking about off-the-shelf remote control airplanes here. To test modern, multi-billion-dollar missile defense networks, the military requires targets that can perfectly mimic the radar cross-section, the speed, the evasive maneuvers of, say, an advanced fifth-generation fighter.
Or an incoming hypersonic cruise missile.
Right. And providing those highly specific targets creates a remarkably durable economic moat for Kratos.
It's an incredible moat. Kratos owns highly specialized intellectual property in aerodynamic engineering and hypersonic flight dynamics. Think about it from the Department of Defense's perspective.
Okay.
When they are certifying an Aegis combat system or a Patriot missile battery, the test parameters are incredibly rigid. They cannot simply swap out their target drone provider to save a minor percentage on a contract.
Because the switching costs would be insane.
Astronomical. You're talking about testing delays, completely new recertification procedures, not to mention the national security risks of delaying deployment.
So that basically locks Kratos into these long-term, very sticky contracts across multiple branches of the armed forces.
Exactly. And when you look at how that translates to the financials, the growth trajectory has just been relentless.
Let's look at the numbers, because they are staggering. The fourth quarter 2025 numbers show revenues in their unmanned systems segment hitting $68.5 million.
A huge jump.
But what really stands out to me is the forward-looking profitability. The consensus estimates are forecasting earnings per share growth of 32.73% for 2026.
And it gets better.
It does. Looking out to 2027, the projection actually accelerates to a 47.52% year-over-year EPS growth rate.
Yeah, seeing nearly 50% earnings growth in a defense contractor, that is highly anomalous.
Extremely anomalous. You do not see that with the legacy primes.
You don't. But it perfectly illustrates the scalability of that attritable manufacturing model we just talked about. When a company is building thousands of low-cost, consumable tactical systems like their Valkyrie drone, the manufacturing efficiencies scale so much faster than building 3 or 4 massive warships a year.
Right. It's an assembly line of drones versus a custom shipyard.
Exactly. And the military is actively pivoting toward this exact architecture, a decentralized fleet of autonomous systems.
Which brings us to the friction point of this whole conversation.
The plunge.
Right. If the operational model is scaling that efficiently and earnings growth is projected at nearly 50%, the market's recent reaction seems entirely disconnected from the fundamentals.
It does feel like a disconnect.
So let's dig into that 22% monthly drop and what really triggered it, because we should be clear, this wasn't a missed earnings report.
No.
And it wasn't a canceled government contract.
Not at all. The catalyst for the plunge was purely financial engineering. Kratos initiated a massive $1.17 billion equity raise.
Billion with a B.
Billion with a B. They priced 14.3 million new shares at $84 each.
And naturally, the market had a swift, very negative reaction to the dilution.
As it always does.
Yeah, I mean, pushing 14.3 million new shares into the float dilutes the equity of the existing shareholders. And we saw the stock immediately reprice downward to meet that $84 offering level.
It's a bitter pill to swallow if you bought at the peak.
Definitely. I mean, why shouldn't an investor view a billion-dollar dilution event as management just cashing in at the top and penalizing the retail shareholder?
That is the standard cynical view of secondary offerings, and honestly, it's often justified.
Right.
But in this case, it requires looking at the balance sheet context to see the strategic intent. The crucial metric here is their leverage. Kratos' total debt to capital is nil.
Zero debt.
Zero. They are operating with a pristine balance sheet in an industry that is notoriously capital intensive.
Which is incredibly rare. Most defense contractors carry significant debt loads to finance their massive manufacturing footprints.
Exactly. And that traditional debt-heavy model leaves them highly vulnerable to sustained high interest rate environments.
So by choosing to issue equity near an all-time high, rather than taking on corporate debt, Kratos essentially bypasses the interest rate trap entirely.
They step right around it. The cash influx isn't going toward debt servicing or restructuring bad loans. It essentially functions as a pure strategic war chest.
And it completely transforms their capital flexibility. Their time-to-interest earned ratio sits at 11.8 times.
Which is fantastic.
It indicates that their operational earnings massively cover any incidental interest expenses they might have. So management basically looked at their projected backlog, realized they needed massive capital to scale up manufacturing facilities for programs like the Valkyrie.
And they determined that raising $1 billion in equity at an $84 valuation was vastly superior to securing $1 billion in commercial debt at current macroeconomic rates.
It makes perfect sense when you lay it out like that. And we also have clarity on exactly where this newly raised capital is being deployed, right?
We do. Beyond scaling those Valkyrie production lines, they just secured a $61.07 million contract modification from the Navy.
This is specifically for those BQM-177A aerial targets we discussed earlier.
Exactly. So having over $1 billion in liquid capital allows them to immediately execute on this backlog. They can procure raw materials at scale and potentially aggressively pursue strategic acquisitions to expand their hypersonic testing capabilities.
So the trade-off for the investor really is accepting a near-term reduction in their percentage of ownership.
In exchange for the company aggressively accelerating its top-line revenue without the drag of debt covenants.
It is a highly aggressive, forward-looking capital allocation strategy.
Very aggressive.
But even with zero debt and $1 billion in cash, we have to scrutinize the current valuation multiples.
Yes, we do.
Because even after the 22% haircut, the stock is trading at a trailing price-to-earnings ratio of 669 times.
It's a huge number.
And more importantly, the forward PE sits at 181 times. You just don't see those kinds of multiples in the industrial sector. That is priced for absolute perfection.
The valuation multiples are undoubtedly stretched by traditional metrics. Trading at 181 times forward earnings indicates that the market is already pricing in a massive disruption of the legacy defense hierarchy.
They're pricing it like a hyper-growth tech stock.
Exactly. Investors aren't paying that multiple for the revenue Kratos will generate next quarter. They are paying for the assumption that by the end of the decade, Kratos' autonomous swarms will have replaced a significant portion of traditional air superiority expenditures.
which introduces significant execution risk for anyone vying in now.
Absolutely.
Operating in bleeding-edge technological fields like space infrastructure and hypersonic glide vehicles, it's notoriously unpredictable. The physics alone present massive engineering hurdles.
You're literally fighting friction and heat at Mach 5.
Right. So if they hit a supply chain bottleneck, or if a major hypersonic testing program suffers a series of high-profile failures, which happens in testing, the margin of safety at a 181x forward multiple is virtually non-existent.
It's zero. Any delay in converting their backlog into recognized revenue could trigger a much steeper structural correction.
So the bear case is entirely predicated on those execution delays.
Yes, they are highly reliant on government bureaucracy, specifically getting final sign-offs and budget appropriations from entities like the Space Development Agency.
And we know how fast the government moves.
Exactly. If those federal budgets stall, or if procurement timelines get pushed to the right, those aggressive 2026 and 2027 earnings estimates we talked about, they will have to be revised downward.
Yet, despite that glaring execution risk and the recent dilution shock, institutional sentiment remains surprisingly resilient.
It really does.
Digging into the analyst coverage, Wall Street maintains a Zacks rank number 2, which indicates a solid buy rating. The average price target across the street sits at $120, with the most aggressive projections reaching $150 per share over the current cycle.
Institutional capital tends to look past the short-term noise of a secondary offering. They are modeling out the structural advantages.
They see the big picture.
Exactly. When a company dominates a niche market with high barriers to entry, carries zero debt, and just added $1 billion in liquidity to its balance sheet, the smart money views the resulting share price drop as a psychological overreaction by retail investors.
So if institutional investors are viewing this as a period of consolidation, let's map out the immediate road ahead, because the timing of this analysis is critical. Today, March 2nd, 2026, marks the official close of that massive $1.17 billion equity offering.
And the closing of the offering is a major technical milestone. Well, for the past several weeks, the market has been dealing with the uncertainty of the share issuance. As of today, the shares are priced, the institutional allocations are settled, and the cash is officially secured on the balance sheet. So the mechanical overhang of the dilution is now safely in the rearview mirror.
Got it. And with that overhang removed, the market's focus will immediately pivot back to execution. The first major test comes up very quickly with their Q1 2026 earnings report, which is scheduled for mid-April.
And that report is going to be hyper-scrutinized.
What specifically are analysts going to be looking for?
They'll be looking for very specific indicators. Honestly, the top-line revenue will be secondary to their forward guidance. The market needs to see management clearly articulate how the new capital is accelerating production schedules.
Right. Show us the money at work.
Exactly. If they can confirm that the 32.73% EPS growth projection for the year is fully intact, or better yet, accelerating due to the increased liquidity, you will likely see a rapid recovery in the share price.
Following that earnings report, the calendar gets heavy with program milestones in Q2. The Navy is scheduled to conduct critical reviews on the BQM-177A program, and we have major fire control reviews coming from the Space Development Agency.
And passing those technical hurdles is what actually unlocks the long-term revenue pipeline.
But to truly understand why the institutional price targets remain in the $120 to $150 range, we have to zoom out. We have to look at the macroeconomic tailwinds.
The big picture again.
Yes. The individual contract reviews are important, of course, but they are happening within the context of a massive, unprecedented shift in federal spending.
It's a generational shift.
The proposed geopolitical defense budgets are just staggering. We are looking at an annual defense spend projected to hit $1.5 trillion by the year 2027.
Trillion with a T.
To contextualize that for you listening, the budget for fiscal year 2026 was hovering around $901 billion.
That is a massive jump.
It is. Adding over $500 billion in annual defense spending fundamentally alters the total addressable market for the entire sector.
And the crucial detail here is that it is not a proportional increase across the board. The Pentagon is not allocating that extra $600 billion to simply buy more legacy tanks or heavily crewed naval vessels.
The era of just building bigger ships is over.
It really is. The strategic doctrine has fundamentally changed. The budgetary increase is heavily skewed toward deterrence technologies. specifically low-cost autonomous drones, advanced space-based tracking architectures, and hypersonic weapons capabilities.
In other words, they are funding the exact niches where Kratos holds a dominant market share.
Exactly.
The macro environment is essentially forcing procurement toward a tradable mass. In a highly contested global security environment, the ability to deploy thousands of interconnected unmanned systems is viewed as the ultimate deterrent.
Kratos isn't just riding a rising tide. They are positioned directly in the center of the fastest-growing current within that $1.5 trillion budget.
Which brings us to the final investment thesis. When you synthesize the operational data, the zero-debt capital structure, the recent dilution event, and the massive macroeconomic catalysts we just outlined, the outlook really requires conviction.
It does. And we are assigning a bullish score of 9 out of 10.
A 9 out of 10. That is an exceptionally high confidence rating, especially for a stock trading at these forward multiples.
It is high, but the rating is based on the multi-year hold opportunity. Look, the short-term pain inflicted by the equity raise is undeniable. If you held through it, it hurt.
Yeah.
But it was a calculated, highly strategic maneuver. Management recognized an opportunity to secure a massive capital advantage over their highly levered competitors. They traded near-term equity value for long-term operational dominance.
So the actionable takeaway for you listening is to objectively evaluate this current price action. The 22% drop was a mechanical reaction to an expanded share float, not a fundamental deterioration of the business model.
Not at all.
In fact, with $1 billion in fresh capital and zero debt obligations, the underlying enterprise is fundamentally stronger today than it was when the stock was trading at $92 a share.
That's the irony of it.
It is. This presents a classic scenario of buying the dilution dip. You have an opportunity here to establish a position ahead of the massive earnings acceleration projected for 2027, right as that $1.5 trillion defense budget begins to convert into actual procurement contracts.
It requires patience to weather the current valuation reset, no doubt. But the strategic alignment between Kratos' technological capabilities and the Pentagon's future operational doctrine is stronger than ever.
Before we wrap up, there is a broader structural question you should ponder, one that extends well beyond this single ticker symbol. We are witnessing a fundamental realignment in how global security is architected and funded.
We really are.
As these unprecedented $1.5 trillion defense budgets collide with a new era of warfare, an era that prioritizes cheap, disposable, and highly autonomous technology over exquisite, decade-long engineering projects, does Kratos' agile, zero-debt, high-volume model signal the beginning of the end for the undisputed dominance of the slow-moving legacy defense giants?
The capital markets are certainly beginning to price in that possibility. It is a paradigm shift that will dictate portfolio returns in the industrial sector for the next decade.
It is a fascinating dynamic to watch unfold. Thank you for tuning in to this analysis. Navigating a high-growth, high-multiple stock requires looking past the immediate technical reactions and understanding the deep structural shifts in capital allocation and government policy. We'll continue to track these catalysts as they develop. Stay sharp, manage your risk, and we'll catch you on the next one.